All right, let's dive right into this explainer. Today, we're unpacking a massive, often hidden roadblock that is stopping next-generation battery technologies right in their tracks. We constantly hear about the incredible scientific promise of new energy storage solutions, right? But there is this incredibly frustrating bottleneck keeping them from actually reaching the grid. So, we're going to look at the insurance and bankability bottlenecks facing alternative battery cell chemistries in utility-scale projects. It's a really fascinating look at what happens when cutting-edge science literally collides head-on with the ultra-conservative world of project finance. Look, in the lab, alternative cell chemistries, things like sodium-ion variants, they look absolutely compelling. They promise new efficiencies, completely different supply chains, and just really exciting technological leaps. But in the real world, man, it is a different story. Project developers are slamming headfirst into a brutal insurance wall. Because as it turns out, getting a battery to work perfectly in a highly controlled laboratory is really only half the battle. Getting someone to actually insure it at a utility scale, that is an entirely different beast. To break down this complex bottleneck today, we'll be looking at three main things. First, hitting the insurance wall. Second, the actuarial data deficit causing it. And third, strategies to actually secure project finance. Okay, let's jump right into part one, hitting the insurance wall. So before we even talk about those new alternative chemistries, we really have to acknowledge the Goliath in the room, and that is LFP, or lithium iron phosphate. To a traditional reinsurer, LFP is basically a warm, safe blanket. They know it, they completely understand it, and most importantly, they will actually back it. Right now, LFP is the absolute strict baseline against which every single new innovation is fiercely judged. And the reality is, traditional reinsurers currently flat out refuse to back anything outside of this established mass market. And failing to use that LFP standard, well, it creates a barrier so massive it can literally bankrupt a project before construction even begins. The path to project bankability just turns into this incredibly frustrating exercise. Seriously, if you bring an alternative chemistry to the table, the insurance costs alone can single-handedly kill your economics. I mean, the project literally dies on a spreadsheet, killed by insurance premiums, before a single battery rack is ever bolted down on site. No way around it. Which brings us to section 2, the actuarial data deficit. So you might be wondering, why are insurers so terrified of anything new? Well, it all basically comes down to math and history, specifically a massive lack of historical loss data. Insurers, they deal in risk, and to calculate that risk, they need decades of actuarial data. But by definition, a next-generation battery simply hasn't existed long enough to generate that kind of history. So without it, underwriters trigger massive financial penalties for developers. They just refuse to back non-LFP tech, and on the rare occasion they do, they demand these crazy, prohibitive list premiums. Because of this huge data deficit, traditional reinsurers treat every slight deviation from the standard LFP model with extreme paranoia. They look at your brilliant, innovative new battery, and all they see is an unquantified fire and liability hazard. And let me tell you, to an underwriter, unquantified is hands down the scariest word in the dictionary. If they can't accurately predict the worst-case scenario, they price your insurance assuming the absolute worst will happen. This creates a massive, massive disconnect between the scientists pushing boundaries and the risk managers actually holding the purse strings. Let's move on to our final piece, Section 3, Strategies to Secure Finance. This brings us directly to the pivotal question that every single project developer, risk officer, and financer must answer if they want their utility-scale projects to survive. How exactly are you bridging the gap? On one side, you've got this urgent, pressing need for next-gen chemistry adoption. On the other side, deeply, deeply conservative underwriting requirements. The ultimate challenge is connecting those two without completely breaking your capital stack. By that, I mean doing it without completely ruining the financial foundation and funding structure of your entire project. So to actually climb over this wall without completely destroying the project economics, developers are forced into some really tough strategic compromises. First, they can hunt for rare, specialized capacity, finding those niche insurers who are actually willing to take a chance on new tech. But what if they can't find those rare backers? Well, then they're pretty much forced into option 2, which is swallowing those prohibitive risk premiums and taking a massive, massive hit to their profit margins. Ultimately, risk officers and developers have to navigate these difficult options to bridge the gap. It's a total high-stakes balancing act just to unlock viable coverage and secure the project finance needed to move forward. As we wrap up this explainer, I want to leave you with a thought to chew on.
What actually happens to the future of our green grid if utility-scale innovation remains permanently trapped behind an insurance wall? I mean, we know the lab results are incredibly compelling, but if we can't figure out a way to satisfy risk managers and overcome this data deficit, our most promising clean technologies might literally never make it out of the laboratory. And honestly, that just goes to show that solving these unglamorous behind-the-scenes financial bottlenecks matters just as much as the scientific breakthroughs themselves.